All right, let's also welcome in Stephen Irons is joining us on the phone line. Stephen, good to have you with us. Your reactions to the fact that the Fed's gone ahead now with the corporate bond buying program, what this implies in terms of sentiment, in terms of a turnaround, because after that sharp fall, we're starting to see a good turnaround coming back. Is this one here to stay?
Well, I think the Fed's generosity should never be questioned. It looks like they're continuing to back Main Street's back, and I think this is really good. It really portrays a really strong view that they're going to look after people in the economy, make sure that there are good jobs to go to. And this resonates. After all, it's going to be a consumer-led rally that's going to bring global economies out of the recession. I think for other investors that wholeheartedly believe that the continuous functional power of liquidity in the markets is going to see investors through the line. And I think this is also the case overnight. There's just such an immense wall of money sitting on bid on dips here that investors are willing to look through all the negatives in the world right now, looking forward to 2021. Look, there's no interest rates. There's no alternatives to invest. Present value is not a concern for future earnings. So, they don't care. They're just buying the dip relentlessly, thinking that as economies reemerge from this lockdown scenario, things are going to return to normal a lot quicker than people think.
Okay, fabulous. So you're saying they're going to return a lot quicker than people think. There's been a lot of talk, Stephen, about how this is disconnected with the economic reality. But on the other hand, that markets are always a step ahead. When you say they may actually recover a lot faster, is there a timeline in mind, given that there's so much uncertainty continuing on the medical and health front?
Well, I totally agree. There is a wild disconnect between the current realities on Wall Street, the current realities in the data versus what's happening on Wall Street. However, we have to remember it only takes a reversal of one deflationary input, and that's the virus itself. Now, it seems to me that the lockdowns have really done well globally, although we're starting to see idiosyncratic rises in case counts globally right now. I don't think that's to be unexpected. I think it's how governments react to these outbreaks. It's going to be more of a key here. How their policy transmission actually moves into the markets. I believe they're just going to use proximity lockdown measures to address individual cases as they pop up. I don't think the threat of a secondary spreader is anywhere near as worrisome as what was being portrayed in the press over the past 2 days. I think we're going to see a V-shaped recovery. I think there's a huge amount of stimulus backing this recovery, and I think things are going to light up very quickly. Now, putting a timeline on this is very difficult because the transmission from government and central bank stimulus right through to assets is asset price reflation is a difficult one to guess at. I mean, looking at 2008, for instance, the road was full of potholes and bumps, and it took a good year to recover. I'd be looking for a full-fledged recovery more towards the mid 2021. But expectations of monetary policy around the world to remain zero will allow investors to look through those bumps and feel positive about investing in markets today.
Okay, so Stephen, hypothetically, if one works with an assumption that a V-shaped recovery is coming, and if indeed a V-shaped recovery is coming for US markets and for the rest of the world, so when the V-shaped recovery will actually happen, markets may not react to it because some would argue that markets have already moved up in anticipation of a V-shaped recovery. So when the actual V-shaped recovery will happen, the most optimistic scenario, do you think markets are unlikely to celebrate?
I tend to agree with that. I think the markets are getting well ahead of the economic realities, and this is the fear, is that once we saw the markets bridge that gap from March all the way back up to a full-fledged recovery last week, we saw huge waves of profit taking. I think there's a sense of reality that does set in once we reach these peaks. I still think, however, there's a little bit more legs in this rally. Whether we move up to 4,000 on the S&P, that's probably the dream level. I think, however, we could adequately move to 3,500 before we start to question whether we're moved too far.
Comments. What is the end game of this liquidity infused world? If one argues that liquidity is long and liquidity is here to stay, what is the end game? Because interest rates are not going to go up in a hurry, and similarly liquidity is not going to vanish also very quickly.
I think we're going to start to see, as the recovery actually progresses, we'll start to see these various central banks throw up trial balloons for reducing that liquidity, especially like they did as reducing the balance sheets. Obviously, that's going to be something that the markets are going to have to react. But we have to be on safer grounds to avoid any semblance of a taper tantrum, and that's something that's going to be very difficult. Look, there's absolutely no playbook, as we saw last year when the Feds tried to reduce the balance sheets and how negative the markets reacted to that. There's no playbook they can use. This is something that, we're coming from levels that are just unquestionably ridiculous when you think about the amount of debt that's in the markets right now, and the fact that the Feds are monetizing all that debt. That's a double whammy. Of course, that's going to be a major concern, but as you correctly alluded to, interest rates are at zero, and it's not and the repayment of that debt's not a huge impact on GDP as a percentage. So, they've got a lot of room to move here, and by the looks of things, the Feds aren't going to move the interest rate needle for at least 2 to 3 more years. So they should be pretty comfortable in the debt markets as far as I'm concerned.
Stephen, good chatting with you, and thanks as always for joining in with your thoughts on what the Fed is going to do and its impact on the markets. Back